Lesson 1 to, let's see. So accounting is an information system that provides reports to users about the economic activities and conditions of a business. The process by which accounting provides information to users is as follows. You identify the users, you assess the user's information needs, you design the accounting information system to meet users' needs, record economic data about business activities and events, and prepare accounting reports for users. Managerial accounting. Internal users of accounting information includes managers and employees. These users are directly involved in managing and operating the business. The area of accounting that provides internal users with information is called managerial accounting or management accounting. The objective of managerial accounting is to provide relevant and timely information for managers' and employees' decision-making needs. Often such information is sensitive and is not distributed outside the business. Examples of sensitive information might include information about customers, prices, and plans to expand the business. Managerial accountants employed by a business are employed in private accounting. Financial accounting. External users of accounting information include investors, creditors, customers, and the government. These users are not directly involved in managing and operating the business. The area of accounting that provides external users with information is called financial accounting. The objective of financial accounting is to provide relevant and timely information for the decision-making needs of users outside of the business. For example, financial reports on the operations and conditions of the business are useful for banks and other creditors in deciding whether to lend money to the business. General purpose financial statements are one type of financial accounting report that is distributed to external users. The long-term general purpose refers to the wide range of decision-making needs that these reports are designed to serve. How does one behave ethically when faced with financial or other types of pressure? Guidelines for behaving ethically follow. Identify an ethical decision by using your personal ethical standards of honesty and fairness. Identify the consequences of the decision and its effect on others. Consider your obligations and responsibilities to those who will be affected by your decision. And finally, make a decision that is ethical and fair to those affected by it. Financial information in the United States is based on the generally accepted accounting principles, GAAP. GAAP is a collection of accounting standards, principles, and assumptions that define how financial information will be reported. Accounting standards are the rules that determine the accounting for individual business transactions. Accounting principles are assumptions provide the framework upon which accounting standards are constructed. Revenue is the amount earned for selling goods or services to customers. The revenue recognition principle determines when revenue is recorded in the accounting records. Normally, revenue is recorded when the services have been performed or goods are delivered to the customer. Expenses are amounts used to generate revenue. The expense recognition principle, sometimes called the matching principle, requires expenses to be recorded in the same period as the related revenue. Doing so allows the reporting of a profit or loss for the period. The business entity, going concern, time period, and monetary unit are underlying principles of GAAP. Under GAAP, the reporting of financial information must adhere to detailed and specific rules. It is a rules-based system, whereas the International Accounting Standards Board, IASB, has set more principles-based standards to accommodate a broader range of national and cultural differences. The accounting equation is assets equals liabilities plus equity. Okay. Here we go. Retained earnings statement. The retained earnings statement reports the change in retained earnings for a period of time. It is prepared after the income statement because the net income or net loss for the period must be reported in this statement. Similarly, it is prepared before the balance sheet, since the amount of retained earnings at the end of the period must be reported on the balance sheet. Because of this, the retained earnings statement is often viewed as the connecting link between the income statement, and the balance sheet. The balance sheet. The balance sheet is a list of assets, liabilities, and shareholders' equity as of a specific date, such as at the end of the month or the year. The statement of cash flows. The statement of cash flows consists of the following three sections. 1. Operating activities. 2. Investing activities. 3. Financing activities. The statement of cash flows contains a summary of cash receipts and cash payments for a period of time based on the revenue and expense recognition principles. The lesson summary. A business provides goods or services, outputs, to customers with the objective of earning a profit. Three types of businesses include service, merchandising, and manufacturing businesses. Accounting is an information system that provides reports to users about the economic activities and condition of a business. Ethics are moral principles that guide the conduct of individuals. Good ethical conduct depends on individual character and company culture. Accountants are engaged in private accounting or public accounting. Generally accepted accounting principles, GAAP, are used in preparing financial statements. To be useful, financial reports should provide information that is relevant and faithful representation of the economic activity or condition. GAAP is based upon the assumptions of monetary unit, time period, business entity, and going concern. The principles of measurement, historical cost, revenue recognition, and expense recognition are an integral part of GAAP. The Financial Standards Board, FASB, Security and Exchange Commission, SEC, and International Accounting Standards Board, IASB, develop standards that are incorporated into GAAP. The resources owned by a business and the rights or claims of these resources may be stated in the form of an equation, as follows: assets equals liability plus equity. All business transactions can be stated in terms of the change in one or more of the three elements of the accounting equation. The primary financial statements of a corporation are the income statement, the retained earnings statement, the balance sheet, and the statement of cash flows. The income statement reports a period's net income or net loss, which is also reported on the retained earnings statement. The ending retained earnings statement reported on the retained earnings statement is also reported on the balance sheet. The ending cash balance is also reported on the balance sheet and the statement of cash flows. Lesson 2, Completing the Accounting Cycle. Objective 1. Describe the flow of accounting information from the unadjusted trial balance into the adjusted trial balance and financial statements. Objective 2. Prepare financial statements from adjusted account balances. Objective 3. Prepare closing entries. Objective 4. Describe the accounting cycle. Objective 5. Illustrate the accounting cycle for one period. Objective 6. Explain what is meant by the fiscal year and the natural business year. Assets. Assets are commonly divided into two sections on the balance sheet. 1. Current assets, and 2. Property, plant, and equipment. Notes receivable are amounts that customers owe. Liabilities. Liabilities are the amounts the business owes to creditors. Liabilities are commonly divided into two sections on the balance sheet: current liabilities and long-term liabilities. A current liability is a liability that will be due within a short time, usually 1 year or less, and that are to be paid out of current assets and are called current liabilities. The most common liabilities in this group are notes payable and accounts payable. Other current liabilities may include wages payable, interest payable, taxes payable, and unearned fees. Long-term liabilities. Liabilities that will not be due for a long time, usually more than a year, are called long-term liabilities. If Net Solutions had long-term liabilities, they would be reported below the current liabilities. Long-term liabilities come due and are to be paid within 1 year, they are reported as current liabilities. If they are to be renewed rather than paid, they would continue to be reported as long-term. When an asset is pledged as security for a liability, the obligation may be called a mortgage note payable or mortgage payable. Stockholders' equity. The stockholders' right to the assets of the business is presented on the balance sheet below the liabilities section. The stockholders' equity of Net Solutions consists of common stock and retained earnings. The stockholders' equity is added to the total liabilities, and this total must be equal to the total assets. Closing entries transfer the balances of temporary accounts to the retained earnings account. The closing process involves the following 4 steps. Revenue account, step 1. Revenue account balances are transferred to an account called income summary. Step 2. Expense account balances are transferred to an account called income summary. Step 3. The balance of income summary, net income or net loss, is transferred to the retained earnings account. Step 4. The balance of the dividends account is transferred to the retained earnings account. Income summary is a temporary account that is also used during the closing process. At the beginning of the closing process, income summary has no balance. During the closing process, income summary will be debited and credited for various amounts. At the end of the closing process, income summary will again have no balance. Because income summary has the effect of clearing the revenue and expense accounts of their balances, it is sometimes called a clearing account. Other titles used for this account include revenue and expense summary, profit and loss summary, and income and expense summary. The income summary account does not appear on the financial statements. The accounting process that begins with analyzing and journalizing transactions and ends with post-closing trial balance is called the accounting cycle. The steps in the accounting cycle are as follows. Step 1. Transactions are analyzed and recorded in the journal. Step 2. Transactions are posted to the ledger. Step 3. An unadjusted trial balance is prepared. Step 4. Adjustment data are assembled and analyzed. Step 5. An optional end-of-period spreadsheet is prepared. Step 6. Adjusting entries are journalized and posted to the ledger. Step 7. An adjusted trial balance is prepared. Step 8. Financial statements are prepared. Step 9. Closing entries are journalized and posted to the ledger. Step 10. A post-closing trial balance is prepared. The ability to convert assets into cash is called liquidity, while the ability of a business to pay its debts is called solvency. 2 financial measures for evaluating a business's short-term liquidity and solvency are working capital and the current ratio. Working capital is the excess of the current assets of a business over its current liabilities. Working capital equals current assets minus current liabilities. The current ratio is another means of expressing the relationship between current assets and current liabilities. The current ratio is computed by dividing current assets by current liabilities. Lesson summary. No, not going to read any of that. Here we go. Which of the following accounts would not be closed to the income summary account at the end of a period? Accumulated depreciation, since all revenue and expense accounts are closed at the end of the period. Accumulated depreciation is a contra asset account that is not closed. Fees earned, wages, expenses, and rent expense would all be closed to income summary. Which of the following entries closes the dividend accounts at the end of the period? Debit the retained earnings account, credit the dividends account. The entry to close the dividends account is to debit the retained earnings account and credit the dividends account. Which of the following accounts in the adjusted trial balance columns of the end of period spreadsheet would be reported on the retained earnings statement? Dividends would be reported. Accounts receivable, cash or other assets that are expected to be converted to cash or sold or used up within 1 year or less through the normal operations of the business are classified as current assets on the balance sheet. Accounts receivable is a current asset since it will normally be converted to cash within 1 year. Office equipment, land, and accumulated depreciation are all reported in the property, plant, and equipment section of the balance sheet. Which of the following accounts would not be included in a post-closing trial balance? Since the post-closing trial balance includes only balance sheet accounts, all of the revenue, expense, and dividend accounts are closed. Fees earned is a temporary account that is closed prior to the preparing the post-closing trial balance. Lesson 3. Objective 1. Describe the cash flow activities reported on the statement of cash flows. Objective 2. Prepare the cash flows from operating activities section of the statement of cash flows using the indirect method. Objective 3. Prepare the cash flows from investing activities section of the statement of cash flows. Objective 4. Prepare the cash flows from financing activities section of the statement of cash flows. Objective 5. Prepare a statement of cash flows. The statement of cash flows reports a company's cash inflows and outflows for a period. The statement of cash flows provides useful information about a company's ability to do the following: generate cash from operations, maintain and expand its operating capacity, meet its financial obligations, and pay dividends. The statement of cash flows reports 3 types of cash flow activities as follows. Number 1, cash flows from operating activities are the cash flows from transactions that affect the net income of the company. Example, purchase and sale of merchandise by a retailer. Number 2, cash flows from investing activities are the cash flows from transactions that affect investments in the non-current assets of the company. Example, purchase and sale of fixed assets such as equipment and buildings. Number 3, cash flows from financing activities are the cash flows from transactions that affect the debt and equity of the company. Example, issuing or retiring equity or debt securities. Cash flows from operating activities include primary cash received from customers or receipts, and cash outflows, payments, made from operating expenses, taxes, interest, supplies, etc. Purchases of real estate and equipment affect a company's long-term asset mix and are examples of cash flows from investing activities. Net income is normally adjusted to cash flows from operating activities using the following steps. Step 1. Expenses that do not affect cash are added. Such expenses decrease net income but do not involve cash payments. Example, depreciation of fixed assets and amortization of intangible assets are added to net income. Step 2. Losses on the disposal of assets are added, and gains on the disposal of assets are deducted. The disposal sale of assets is an investing activity rather than an operating activity. However, such losses and gains are reported as part of net income. As a result, any losses on disposal of assets are added back to net income. Likewise, any gains on disposal of assets are deducted from net income. Example, land costing $100,000 is sold for $90,000. The loss of $10,000 is added back into net income. Step 3. Changes in current operating assets and liabilities are added or deducted as follows. Increases in non-cash current operating assets are deducted. Decreases in non-cash current operating assets are added. Increases in current operating liabilities are added. Decreases in current operating liabilities are deducted. Example, a sale of $10,000 on account increases sales, accounts receivable, and net income by $10,000. However, cash is not affected. Thus, the $10,000 increase in accounts receivable is deducted. Similar adjustments are required for the changes in the other current asset and liability accounts, such as inventory, prepaid expense, accounts payable, accrued expenses payable, and income taxes payable. IFRS for statement of cash flows. The statement of cash flows is required under International Financing Report Standards, IFRS, or IFRS. The statement of cash flows under IFRS is similar to that reported under US GAAP in that the statement has separate sections for operating, investing, and financing activities. Like US GAAP, IFRS also allow the use of either the indirect or direct method of reporting cash flows from operating activities. IFRS differ from US GAAP in some minor areas, including interest paid can be reported as either an operating or a financing activity, while interest received international connection can be reported as either an operating or an investing activity. In contrast, US GAAP reports interest paid or received as an operating activity. Dividends paid can be reported as either an operating or a financing activity, while dividends received can be reported as either an operating or an investing activity. In contrast, US GAAP reports dividends paid as financing activities and dividends received as an operating activity. Cash flows to pay taxes are reported as a separate line in the operating activities, in contrast to US GAAP, which does not require a separate line disclosure. Issuing new bonds, debt financing, or new shares of stock, equity financing, affect the levels of corporate debt and equity. These are examples of cash flows from financing activities. Cash flows from financing activities and those from investing activities can seem familiar. Cash flows from investing activities occur when a company acquires or sells long-term assets, such as land, equipment, or outside investments. These are transactions that affect the asset side of the balance sheet. Financing activities, on the other hand, include cash flows that occur when the company sells a share of stock or issue bonds to raise capital. These transactions affect a company's long-term liabilities and shareholders' equity. The other side of the basic accounting equation. Lesson summary. The statement of cash flows reports cash receipts and cash payments by three types of activities: operating, investing, and financing activities. Cash flows from operating activities reports the cash inflows and outflows from a company's day-to-day operations. Cash flows from investing activities reports the cash inflows and outflows related to changes in a company's long-term assets. Cash flows from financing activities reports the cash inflows and outflows related to changes in a company's long-term liabilities and stockholders' equity. Investing and financing for a business may be affected by transactions that do not involve cash. The effect of such transactions should be reported in a separate schedule accompanying the statement of cash flows. The indirect method reports cash flows from operating activities by adjusting net income for revenues and expenses that do not involve the receipt or payment of cash. Non-cash expenses, such as depreciation, are added back to net income. Gains and losses on the disposal of assets are added to or deducted from net income. Changes in current operating assets and liabilities are added to or subtracted from net income, depending on their effect on cash. Cash flows from investing activities are reported below cash flows from operating activities on the statement of cash flows. Cash flows from investing activities reports the cash inflows and outflows related to changes in a company's long-term assets. Cash flows from financing activities are reported below cash flows from operating activities on the statement of cash flows. Cash flows from financing activities reports the cash inflows and outflows related to changes in a company's long-term liabilities and stockholders' equity. The statement of cash flows reports cash flows from operating activities followed by cash flows from investing and financing activities. The result of adding the net cash flows from operating, investing, and financing activities is the net increase or decrease in cash for that period. Cash at the beginning of the year is added to determine the cash at the end of the period. This ending cash amount must agree with the cash reported on the end of period balance sheet. Lesson 4. Liquidity. Short-term creditors, such as banks and financial institutions, are primarily concerned with whether a company will be able to repay short-term borrowings, such as loans and notes. As such, they are most interested in evaluating a company's ability to convert assets into cash, which is called liquidity. Solvency. Long-term creditors, such as bondholders, loan money for long periods of time. Thus, they are interested in evaluating a company's ability to make its periodic interest payments and repay the face amount of debt at maturity, which is called solvency. Profitability. Investors, such as stockholders, are the owners of the company. They benefit from increases in the price of a company's shares and are interested in evaluating the potential for the price of a company's stock to increase. The price of a company's stock depends on a variety of factors, including the company's current and potential future earnings. As such, investors focus on evaluating a company's ability to generate earnings, which is called profitability. The analysis of increases and decreases in the amount and percentage of comparative financial statements items is called horizontal analysis. The percentage analysis of the relationship of each component in a financial statement to a total within the statement is called vertical analysis. In a common size statement, all items are expressed as percentages with no dollar amount shown. Current position analysis evaluates a company's ability to pay its current liabilities. The current ratio is a more reliable indicator of a company's ability to pay its current liabilities than its working capital, and it is much easier to compare across companies. Quick assets are cash and other current assets that can be easily converted to cash. Quick assets normally include cash, temporary investments, and receivables, but exclude inventories and prepaid assets. A company's ability to collect its accounts receivable is called accounts receivable analysis. It includes the computation and analysis of the following: accounts receivable turnover and number of days sales in receivable. Lesson summary. The basic financial statements provide important information that users rely on to make economic decisions. Financial statement users typically evaluate this information along 3 dimensions: liquidity, solvency, and profitability. 2 common techniques are used to analyze a company's financial performance and condition: analytical methods and ratios. Both analytical methods and ratios can be used to compare a company's financial performance over time or to another company. Analytical methods are used to compare items on a current financial statement with related items on earlier statements or to examine relationships within a financial statement. Horizontal analysis is the analysis of percentage increases and decreases in related items in comparative financial statements. The analysis of the relationship of each component is a financial statement to a significant total within the statement is called vertical analysis. In a common size statement, all items are expressed as percentages with no dollar amount shown. Liquidity analysis evaluates a company's ability to convert current assets into cash. Short-term creditors use liquidity analysis to evaluate a company's ability to repay short-term debts by focusing on a company's current position, accounts receivable, and inventory. The measures and ratios used to evaluate a company's liquidity include working capital, current ratio, quick ratio, accounts receivable turnover, number of days in sales receivable, inventory turnover, and number of days in inventory. Solvency analysis evaluates the ability of a company to pay its long-term debts. Long-term creditors use solvency analysis to evaluate a company's ability to make its periodic interest payments and repay the face amount of bonds at maturity. Solvency is normally assessed by examining 1. The ratio of fixed assets to long-term liabilities, 2. The ratio of liabilities to stockholders' equity, and 3. The times interest earned ratio. 5. Profitability analysis focuses on the relationship between operating results, income statement, and assets, balance statement. Profitability analysis include 1. The asset turnover ratio, 2. The return on total assets, 3. The return on stockholders' equity, 4. The return on common stockholders' equity, 5. Earnings per share on common stock, 6. The price earnings ratio, 7. Dividends per share, and 8. Dividend yield. Public corporations issue annual reports summarizing their operating activities for the past year and plans for the future. In addition to the financial statements and accompanying notes, annual reports include management discussion and analysis, MD&A, a report on internal control, and a report on fairness of the financial statements. Management discusses an analysis includes management's analysis of current operations and its plans for the future. The report on internal control states management's responsibility for establishing and maintaining internal controls. The report on fairness of the financial statements provides the CPA firm's opinion on whether the financial statement fairly present the financial position, results of operations, and cash flows of a company. Lesson 5. Distinguish between the activities and financial statements of service and merchandising businesses. The operating cycle is the process by which a company spends cash, generates revenue, and receives cash either at the time the revenues are generated or later by collecting an accounts receivable. The operating cycle of a service and merchandising business differs in that a merchandising business must purchase merchandise for sale to customers. Hello. Hello. Lesson 6, Managerial Accounting. So we're going to describe managerial accounting, including its differences with financial accounting, its place in the organization, and its uses. We're going to describe and illustrate the nature of manufacturing operations, including different types of classifications of costs. We're also going to describe sustainable business activities and eco-efficiency measures. And we're lastly going to describe and illustrate financial statements for a manufacturing business, including the balance sheet, statement of costs of goods manufactured, and income statement. Managerial accounting information is designed to meet the specific needs of a company's management. This information includes the following: historical data, which provides objective measures of past operations, and estimated data, which provides subjective measures about estimates about future decisions. Management uses both types of information in directing daily operations, planning future operations, and developing business strategies. Sustainability is the practice of operating a business to maximize profits while attempting to preserve the environment, economy, and needs of future generations. Sustainability practices acknowledge that a company's long-term success requires the continued availability of natural resources and a productive social environment. Eco-efficiency measures are a form of managerial accounting information that helps managers evaluate the savings generated by using fewer natural resources in a company's operations. The statement of costs of goods manufactured is prepared using the following 3 steps. Step 1, determine the cost of direct materials used during the period. Step 2, determine the total manufacturing costs incurred during the period. And step 3, determine the cost of goods manufactured during the period. Oh geez. Lesson 6, Summary. Managerial accounting is a staff function that supports the management process by providing reports to aid management in planning, directing, controlling, improving, and decision-making. This differs from financial accounting, which provides information to users outside of the organization. Managerial accounting reports are designed to meet the specific needs of management and aid management in planning long-term strategies and running the day-to-day operations. Managerial accounting provides a variety of information for decision-making for use in operating a business. Manufacturing companies use machinery and labor to convert materials into a finished product. A direct cost can be directly traced to a finished product, while indirect costs cannot. The cost of a finished product is made up of 3 components: direct materials, direct labor, and factory overhead. These 3 manufacturing costs can be categorized into prime costs, direct materials and direct labor, or conversion costs, direct labor and factory overhead. Product costs consist of the elements of manufacturing costs, direct materials, direct labor, and factory overhead, while period costs consist of selling and administrative expenses. To make sound strategic and operational decisions, managers must consider the social and environmental conditions in which their company operates. Sustainability is the practice of operating a business to maximize profits while attempting to preserve the environment, economy, and needs of future generations. Sustainability information provides important internal feedback that helps guide a company's strategic and operational decision making. This information also helps external financial statement users evaluate the risks and opportunities a company faces that are tied to the environment in which it operates. The financial statements of manufacturing companies differ from those of merchandising companies. Manufacturing companies' balance sheets report 3 types of inventory: materials, work in process, and finished goods. The income statement of manufacturing companies reports the cost of goods sold, which is the total manufacturing cost of the goods sold. The income statement is supported by the statement of cost of goods manufactured, which provides the details of the cost of goods manufactured during the period. Lesson 7, Cost Volume Profit Analysis. Objective 1, classify costs as variable costs, fixed cost, or mixed costs. Objective 2, compute the contribution margin, the contribution margin ratio, and the unit contribution margin. Objective 3, determine the break-even point and sales necessary to achieve a target profit. Using Objective 4, using a cost volume profit chart and a profit volume chart, determine the break-even point and sales necessary to achieve a target profit. Objective 5, compute the break-even point for a company selling more than one product, the operating leverage, and the margin of safety. Cost behavior is the manner in which a cost changes as a related activity changes. Fixed costs are costs that remain the same in total dollar amounts as the activity base changes. When the activity base is units produced, many factory overhead costs, such as straight-line depreciation, are classified as fixed costs. Mixed costs are costs that have characteristics of both a variable and a fixed cost. Mixed costs are sometimes called semi-variable or semi-fixed costs. One method of reporting variable and fixed costs is called variable costing or direct costing. Under variable costing, only the variable manufacturing cost, direct materials, direct labor, and variable factory overhead are included in the product cost. The fixed factory overhead is treated as an expense of the period in which it is incurred. Cost volume profit analysis is the examination of the relationships among selling prices, sales and production volume, costs, expenses, and profits. Cost volume profit analysis is used for managerial decision making. Some of the ways cost volume profit analysis may be used include the following. Analyzing the effects of changes in selling prices on profits, also analyzing the effects of changes in cost on profits, analyzing the effect of changes in volume on profits, setting selling prices, selecting the mix of a product to sell, choosing among market strategies. The break-even point is the level of operations at which a company's revenues and expenses are equal. The margin of safety indicates the possible decrease in sales that may occur before an operating loss results. Thus, if the margin of safety is low, even a small decline in sales revenue may result in an operating loss. Managerial accounting provides many of the tools and information required for day-to-day decision-making regarding business operations. Since few companies sell only one product or service, the weighted contribution margin of each product or service in the firm's sales mix is incorporated into the cost volume profit analysis to evaluate relative break-even sales quantities. 7. Summary. Summary. Number 1. Variable costs vary, in proportion to changes in the level of activity. Fixed costs remain the same in total dollar amount as the level of activity changes. Mixed costs are comprised of, you're never going to guess this, both fixed and variable costs, right? How freaking original. Contribution margin is the excess of sales revenue, other variable costs, and can be expressed as a ratio, contribution margin ratio, or dollar amount, unit contribution margin. Hello. The break-even point is the point at which a business's revenues exactly equal costs. The mathematical approach to cost volume profit analysis uses the unit contribution margin concept and mathematical equations to determine the break-even point and the volume necessary to achieve a target profit. Graphical methods can be used to determine the break-even point and the volume necessary to achieve a target profit. A cost volume profit chart focuses on the relationship among costs, sales, and Bustafer Jones. Operating profit or loss. The profit volume chart focuses on profits rather than on revenues and costs. Cost volume profit relationships can be used for analyzing the effects of sales mix on the break-even point and profits. Operating leverage can be used to analyze the effects of changes in sales on income from operations. The margin of safety indicates how much sales must decrease before an operating loss occurs. Oh geez. Lesson number 8, budgeting. Objective number 1, describe budgeting, its objectives, and its impact on human, not animal, behavior. Objective 2, describe the basic elements of the budget process, the 2 major types of budgeting, and the use of computers in budgeting. Objective 3, describe the master budget for a manufacturing company. Objective 4, prepare the basic operating budgets for a manufacturing company. And objective 5, prepare financial budgets for a manufacturing company. Planning may be described, or let me start that over. Planning may be classified as follows. Strategic planning, which is developing long-term actions to achieve the company's objectives. These long-term actions are called strategies, which often involve periods of 5 to 10 years, like strategical decision-making, same kind of thing. Tactical planning or operational planning, which develop short-term actions for managing the day-to-day operations of the company. Operational planning, day-to-day operations. Budgeting involves planning, directing, and controlling. A static budget shows the expected results of a responsibility center for only one activity level, and the budget is not changed, even if the activity level changes. Flexible budgets show the expected results of a responsibility center for several activity levels. A flexible budget is, in effect, a series of static budgets for different levels of activity. A flexible budget is constructed as follows. Step 1. Identify the relevant activity levels. The relevant levels of activity could be expressed in units, machine hours, direct labor hours, or some other activity base. Step 2. Identify the fixed and variable cost components of the costs being budgeted. Step 3. Prepare the budget for each activity level by multiplying the variable cost per unit by the activity level and then adding the monthly fixed costs. The 2 most popular computerized approaches to budgets are spreadsheets, like Excel, and integrated budget and planning B&P software systems. The master budget, that's master in our English, is an integrated set of operating and financial budgets for a period of time. Most companies prepare a master budget on a yearly basis. The sales budget begins by estimating the quantity of sales. The prior year sales are often used as a starting point. The production budget should be integrated with the sales budget to ensure that production and sales are kept in balance during the year. The production budget estimates the number of units to be manufactured to meet budget sales and desired inventory levels. The direct labor cost budget estimates the direct labor hours and related costs needed to support budgeted production. Production managers study work methods to provide estimates used in preparing the direct labor cost budget. The factory overhead cost budget estimates the cost for each item of factory overhead needed to support budgeted production. The cost of goods sold budget is prepared by integrating the following budgets. So there's direct materials purchases budget, direct labor cost budget, and the factory overhead cost budget. Isn't that fascinating? The budgeted income statement is prepared by integrating the following budgets. So the sales budget, cost of goods sold budget, and the selling and administrative expenses budget. So the capital expenditures budget summarizes plans for acquiring fixed assets. Such expenditures are necessary as machinery and other fixed assets wear out or become obsolete. In addition, purchasing additional fixed assets may be necessary to meet increasing demand for the company's product. A capital expenditure budget is used to summarize plans for acquiring fixed assets. You could include building in your capital budget, right? If you're going to build a new building, that's capital. If you're going to install a new network in your building, that's capital, all that stuff. Lesson 7 or 8 lesson summary. Budgeting involves 1. Establishing plans, which is planning, 2. Directing operations, which is directing, and 3. Evaluating performance, which is controlling. In addition, budgets should be established to avoid human behavior problems. Number 2, the budget estimates received by the budget committee should be carefully studied, analyzed, revised, and integrated. The static and flexible budgets are two major budgeting approaches. Computers can be used to make the budget process more efficient and organizationally integrated. The master budget, this is number 3, the master budget is an integrated set of operating and financial budgets for a period of time. The operating budgets are prepared and integrated into a budgeted income statement. The financial budgets are prepared and integrated into a budget balance sheet. The basic operating budgets are the sales budget, the production budget, direct materials purchase budget, direct labor cost budget, factory overhead cost budget, cost of goods sold budget, and selling and administrative expenses budget. These budgets are the basis for preparing a budgeted income statement. The cash budget and capital expenditures budget are financial budgets showing the investing and financing activities of the firm. These budgets are the basis for preparing a budgeted balance sheet. Administrative departments, such as purchasing or HR, will often use static budgeting. Now, lesson 9, the capital budgeting process. Which step in the capital budgeting process predicts and analyzes risks associated with future cash flows, makes forecasts about alternative cash flows, examines how sensitive outcomes may be to changes in cash flows, and considers alternative estimates of a project's net present value? Financial analysis and appraisal of a project attempts to predict expected future cash flows from the project, examine the risk or risks associated with those cash flows, develop alternative cash flow forecasts, evaluate sensitivity of the results to possible changes in predicted cash flows, and compute alternative estimates of the project's net present value. NP Victor. I lost my place. Where did it go? Oh, there it is. Thus, the project analysis can involve the application of forecasting and project evaluation techniques, along with the risk analysis and mathematical programming techniques such as linear programming, linearly irrelevant to the entirety of the world. Lesson number 10. Evaluating decentralized operations. So, number 1, objective 1, describe the advantages and disadvantages of decentralized operations. Objective 2, prepare a responsibility accounting report for a cost center. Oh no. Objective 3, prepare responsibility accounting reports for a profit center. So cost center, profit center. Got it. So in a centralized company, all major planning and operation or operating decisions are made by top-level management. For example, one person, owner-manager operated company is centralized because all plans and decisions are made by one person. In a small owner-manager operated business, centralization may be desirable. This is because the owner-manager's close supervision ensures that the business will operate in the way the owner-manager wishes. In a decentralized company, managers of separate divisions or units are delegated operating responsibilities. The division or unit managers are responsible for planning and controlling the operations of their divisions. Divisions are often structured in and around products, customers, or regions. The proper amount of decentralization for a company depends on the company's unique circumstances. For example, in some companies, division managers have authority over all operations, including fixed asset purchases. In other companies, division managers have authority over profits, but not fixed asset purchases. A profit center manager has the responsibility and authority for making decisions that affect revenues and costs and thus profits. Profit centers may be divisions, departments, or products. The manager of a profit center does not make decisions concerning the fixed assets invested in the center. However, profit centers are an excellent training assignment for new managers. Responsibility, accounting for profit centers focus on reporting revenues, expenses, and income from operations. Thus, responsibility accounting reports for profit centers take the form of income statements. The profit center income statement should include only revenues and expenses that are controlled by the manager. Controllable revenues are revenues earned by the profit center. Controllable expenses are costs that can be influenced or controlled by the decisions of the profit center managers. The rates at which services are charged to each division are called service department rate change rates. These rates are computed as follows. Who cares? It's a formula. Those are all just formulas. Goodbye. All right, lesson number 11. We're going to talk about capital investment analysis. So capital investment analysis, or capital budgeting, is the process by which management plans, evaluates, and controls investments in fixed assets. Capital investments use funds and affect operations for many years and must earn a reasonable rate of return. Thus, capital investment decisions are some of the most important decisions that management makes. Some methods that do not use present values: the average rate of return, cash payback method, do not use present values. The methods that do use present values is the net present value method and the internal rate of return method. So present values, obviously net present value, and then internal rate of return. Capital rationing is the process by which management allocates funds among competing capital investment proposals. So, to summarize, number 1, capital investment analysis is the process by which management plans, evaluates, and controls investments involving fixed assets. Capital investment analysis is important to a business because such investments affect profitability for a long period of time. Yawn. Number 2, the average rate of return method measures the expected profitability of an investment in fixed assets. The expected period of time that will pass between the date of an investment and the complete recovery in cash or equivalent of the amount invested is the cash payback period. The net present value method computes the net present value of the cash inflows expected from a proposal and compares the results to the amount to be invested. The internal rate of return method uses present values to compute the rate of return from the net cash flows expected from capital investment proposals. Oh boy, I'm getting tired. Factors that may complicate capital investment analysis include the impact of income tax, unequal lives of alternative proposals, leasing, uncertainty, changes in price levels, and qualitative considerations. Capital rationing refers to the process by which management allocates available investment funds among competing capital investment proposals. Lesson 12. Managing finance in the short term. Working capital is defined as current assets less current liabilities, or net current assets. It consists of 4 key elements: your inventory, your accounts receivable, your accounts payable, and your bank account. And each of these needs to be managed to ensure there are adequate funds for maintaining the short-term business cycle. The broad principles of managing the short-term working capital is to hold as little inventory as possible, get the money in quickly, and pay it out slowly. Ooh. Lesson 13. Managing finance in the long term. There are three principal sources of long-term finance. There's the money supplied by investors or shareholders, also called share capital. There's the profits the company has made, which is called retained profit. And there's the money that they have borrowed, principally like bank loans, right? In other words, it is the money invested, the money made, and the money borrowed. There are two types of loans. There is the simple negotiated bank loan, and there are loans traded on a stock market, sometimes referred to as the corporate bond market. Basic aspects of loans are as follows. They are the least costly source of long-term finance. Loans are the least costly source of long-term finance. Loan interest is tax deductible, unlike dividends, making them even more cost-effective. They are the least risky to the lender, as they are paid off before shares in the event of liquidation. They can be secured, they can be redeemed, or they can be irredeemable, like Kylo Ren. And then lastly, like preferred shares, they can be converted into ordinary shares upon a given event called convertible loan stock. Loan stock. Excessive loans causing excessive interest will create a very high level of risk to the company's longevity. Venture capital. These are companies specializing in startup growth, buyout, or restructuring capital with a view to longer-term company flotation or sale. Business angles. These are individual investors who invest smaller amounts, like up to 100,000 quid, in developing companies in return for a shareholding. Then you have the old government. Their grants, match funding, and tax incentives to help specific industries or geographic areas are available. Your sales and leaseback. This is where an asset previously owned by the company, such as a building, is sold to a lesser company with a right of continued use of the property. This will give an immediate injection of funds, but with the obvious loss of ownership of the asset, with ensuing rent reviews and loss of possible capital growth in the asset. Your finance leases. These are commonly used where an asset is purchased for the overwhelming majority of the life of the asset and allow the lessee full use of the asset without the financial outlay. For instance, a car may be purchased on a 4-year lease. The legal ownership rests with the lessor, although the car will be shown in the lessee's balance sheet under non-current assets, along with outstanding lease payments and the long-term liabilities. It is attractive for medium-term borrowing as it releases cash flow. The interest tends to be competitive and is tax deductible. The lessee is not tied to ownership, and the lessor has the security of the asset for the lending, making the borrowing comparatively easy. A cash budget is a projection, usually monthly, quarterly, or annually, of the company's cash position based upon expected income and expenditure over the period. It is the result of all the other budgets, such as sales, production, purchases, and wages, expressed in monetary terms as to their effect on the bank balance. It should not be confused with a cash flow statement, which is part of the historical published accounts. Cash itself is a commodity which is required to run a business, and it should be treated like any other resource. There needs to be an adequate flow of cash and liquidity in the company for it to survive, and the profitability of the company is one way to achieve this. But of course, money can come from outside, such as from shareholders or banks. Debt financing, namely corporate bonds and bank loans, is the least expensive form of long-term financing due to the tax deductibility of interest payments. By contrast, dividend payments on shares of preferred and common stock are not deductible for tax purposes. Ordinary or common shares of stock are considered riskiest to stockholders because they are the last to be paid if any asset remain after a corporate bankruptcy liquidation. Similarly, dividends are paid to common stockholders, you see, last, with owners of preference shares of stock first in line for any declared dividends. Lenders to the firm, such as banks and bondholders, are the first to be compensated with liquidated assets during a corporate bankruptcy, making these forms of financing less risky for the lenders. Lesson 14, the cost of capital. The items in the liability and equity sections of a firm's balance sheet, various types of debt, preferred stock and common equity are its capital components. Capital, which generally is described as a firm's long-term sources of funds, is a necessary factor of production, because any increase in total assets must be financed by an increase in one or more of the capital components. Like any other factor or production, capital has a cost. The cost of each type of funds is called the component cost of that particular type of capital. And the costs of capital represent the rates of return that the firm pays to investors to attract various forms of capital funds. Which component of capital structure is adjusted to account for tax savings? Since the interest expense on debt is tax deductible, the cost of debt is adjusted to account for the tax savings associated with the interest payments. The cost of capital used in capital budgeting should be calculated as a weighted average or combination of the various types of funds generally used, regardless of the specific financing used to fund a particular project. Each firm has an optimal capital structure, a mix of debt, preferred stock, and common equity that causes its stock price to be maximized. The target proportions of debt, preferred stock, and common equity, along with the component costs of capital, are used to calculate the firm's weighted average cost of capital, or wiggity wiggity whack, WACC. The WACC simply represents, yeah, freaking right. Have you ever seen the WACC formula? Nothing simple about it. So many brackets. Simply represents the average cost of each dollar of financing, no matter its source, that the firm uses to purchase assets. That is, WACC represents the minimum rate of return the firm must earn on its investment or assets to maintain its current value. Your common equity is like 0.5% times total new capital raised. To conclude, we summarize some of the capital concept rules that we discussed. So, number one, to make appropriate capital budgeting decisions, the firm must know its required rate of return, which is defined as the average rate of return that the firm pays to attract investors' funds. Because the firm pays the average rate of return to investors who provide its long-term funds capital, the firm's required rate of return is also referred to as its cost of capital. To determine its required rate of return, the firm must compute the cost of each source of funds or capital that investors provide. That is, the firm must compute the cost of debt, the cost of preferred stock, the cost of retained earnings, the cost of new common equity. These costs are then combined by weighting each component by the proportion or weight that it contributes to the total capital of the firm. The result is the weighted average cost of capital, or the WACC, which is the required rate of return that the firm should use when making capital budgeting decisions. Investors who participate in the financial markets determine firms' WACCs, not WAX, WACC, small s. Investors only provide funds to firms if they expect to earn sufficient returns on their investments. Thus, firms must pay investors' demands, required returns to attract funds. When investing in capital budgeting projects, a firm should follow the economic principles that asserts products should continue to be manufactured until marginal costs equal marginal revenues. In other words, the firm should invest until the marginal cost of capital, marginal costs, equals the internal rate of return on the last project that is purchased, marginal revenues. Huh. Lesson 15, Capital Structure. Risk can be divided between market risk, which is measured by the firm's beta coefficient, and total risk, which includes both beta risk and a type of risk that can be eliminated by diversification. Firm-specific risk. Capital budgeting decisions affect the riskiness of the firm, so we can differentiate between beta risk, the effect of a project on the firm's beta, and corporate risk, the effect of a project on the firm's total risk. Now, we introduce two new dimensions of risk, business risk and financial risk. Business risk is defined as the uncertainty inherent in projections of future returns, either on assets or on equity. If the firm uses no debt or debt-like financing, That is, debt, like financing would be like preferred stock. That is, it is the risk associated with the firm's operations, ignoring any financing efforts. That's business risk. Financial risk is defined as the additional risk over and above basic business risk placed on common stockholders that results from using financing alternatives with fixed periodic payments, such as debt and preferred stock. That is, it is the risk associated with the types of funds the firm uses to finance its assets. Conceptually, the firm has a certain amount of risk inherent in its production and sales operations. This is its business risk. When it uses debt, it partitions this risk and concentrates most of it on one class of investors, the common stockholders. This is its finance risk. 1. Both business risk and finance risk affect the capital structure of a firm. A firm's capital structure is the combination of debt and equity used to finance the firm's investments in various projects. Business risk depends on a number of factors, the more important of which include the following. Number 1, sales variability, volume and price. The more stable, certain the unit sales, volume, and prices of a firm's products, the lower its business risk, other things being constant. Input price variability. A firm with highly uncertain input prices, labor, product costs, and so forth is exposed to a high degree of business risk. Number 3, ability to adjust output prices for changes in input prices. The greater the ability of a firm to adjust selling prices of its products when input costs change, the lower the degree of business risk. This factor is especially important during periods of high inflation. The extent to which costs are fixed, operating leverage. If a high percentage of a firm's operating costs are fixed and hence do not decline when demands fall off, this increases the company's business risk. This factor is called operating leverage. This topic will be discussed in detail later in the lesson. Each of these factors is determined partly by the firm's industry characteristics, but each is also controllable to some extent by management. For example, most firms can, through their marketing policies, take actions to stabilize both unit sales and sales prices. However, this stabilization might require either large expenditures on advertising or price concessions to induce customers to commit to purchasing fixed quantities at fixed prices in the future. Similarly, some firms can reduce the volatility of future input costs by negotiating long-term labor and material supply contracts. Of course, they might have to agree to pay prices somewhat above the current price to obtain these contracts. So, question. Which situation would intensify the business risk borne by a firm's common stockholders? When a firm uses debt securities to raise capital, this creates financial leverage and increases the amount of business risk borne by common stockholders. We define financial risk as the additional risk over and above basic business risk that is placed on common stockholders when the firm uses financing alternatives that require fixed periodic payments. Thus, financial risks result from using financial leverage, which exists when a firm uses fixed income securities such as debt and preferred stock to raise capital. If a firm changes the percentage of debt used to finance existing assets, we would expect the earnings per share, EPS, and consequently the stock price to change as well. The degree of operating leverage, DOL, is defined as the percentage change in net operating income, NOI, that is earnings before interest and taxes, or EBIT, associated with a given percentage change in sales. We have seen that 1, the greater the degree of operating leverage, fixed operating costs, the more sensitive EBIT will be to a change in sales, and 2, the greater the degree of financial leverage, fixed financial costs, the more sensitive EPS, earnings per share, will be to a change in earnings before interest tax. Therefore, we can conclude that when a firm uses a considerable amount of both operating and financial leverage, even small changes in sales will lead to wide fluctuations in earnings per share. Some practical difficulties are associated with the type of analysis described in the previous section, including the following. It is difficult to determine exactly how either price-earnings ratio or equity capitalization rates are affected by different DFLs. A firm's managers might be more or less conservative than the average stockholders, so management might set a somewhat different target capital structure than the one that would maximize the stock price. Managers of a publicly owned firm never would admit this because they might be removed from office if they did. Managers of large firms, especially those that provide vital services such as electricity, have a responsibility to provide continuous service. Therefore, they must refrain from using leverage to the point where the firm's long-run survival is endangered. Long-run viability might conflict with short-run stock price maximization and capital cost minimization. For all these reasons, managers are concerned about the effects of financial leverage on the risk of bankruptcy, and an analysis of this factor is therefore an important input in all capital structure decisions. Accordingly, managers give considerable weight to financial strength indicators such as times interest earned ratio, which is computed by dividing firm's EBIT by its interest expense. So the greater the firm's business risk, or the riskiness that would be inherent in the firm's operations if it used no debt, the lower the amount of debt that is optimal. Financial risk is the risk common stockholders must take when the firm uses financing alternatives that require fixed periodic payments, for example, debt and preferred stock. Firms that maintain financial flexibility or the ability to raise capital on reasonable terms under adverse conditions are less risky and find it easier to raise funds when money is tight than firms that don't have financial flexibility. Some managers are more aggressive than others when using debt, hence managerial attitude, conservatism, or aggressiveness influences the amount of debt a firm takes on. This factor does not affect the optimal or value maximizing capital structure. Leverage, which is the presence of fixed costs, both operating and financial, magnifies the effects of changes in sales on operating income and net income. Everything else the same, more leverage generally indicates more risk. Thus, leverage should be considered when making capital structure decisions. Even though scientific models have not been developed to determine the optimal capital structure of a firm, it is important for a company to evaluate the effects of leverage on its value to establish a target capital structure that can be followed when raising funds. Lesson 17, outsourcing financial aspects. So outsourcing is a complex subject with strategic, operational, legal, and financial implications. The main purpose, the mechanics, no. Let's see. What is outsourcing? Outsourcing means different things to different people. A working definition of IT outsourcing is as follows: a contractual relationship for the provision and management of IT services by an external supplier, under which 1. The services are customized to the customer's requirements such that payment by the customer will be related to the achievement of agreed service levels and specified results. 2. The services may be carried out at the customer's premises or at those of the supplier. And 3. The outsourcing may, and typically does, include the transfer of non-current assets and/or people from the customer to the supplier. The main headings to which consider would nearly always have to be given in an IT outsourcing decision are the following. Although in practice there may of course be others, under each heading is a brief checklist of the main points that will usually have to be considered in that context. All of these main points feature in the worked example that blah blah blah. So hardware, trade-in or transfer values of existing hardware, purchase prices or lease payments for new, lease termination, extension or assignment change charges, maintenance, power, and insurance, in profit and loss financial cases only, depreciation and losses on profit on disposal. For software, there's license fees, which are lump sums or finance payments, annual maintenance charges, there's license transfer fees. In profit and loss cases only, there's amortization and losses on transfer or cessation of use. Premises, sale, price, or rent existing. purchase price on rent of new, any sub-rent receivable, and running costs. People. Salaries and overheads, redundancy payments, costs of people retained or hired for liaison with an outsourcing supplier, and outsourcing consultancy fees. Administrative overheads, if these will change as a result of outsourcing, then they should be included. Service enhancements, see the similarly titled section earlier in this chapter. Outsourcing charges, whatever. To remind you, the golden rule for financial cases designed to assist decision making is restated as follows. In cash flow, financial cases include future cash outflows and inflows that differ among the alternatives, include cash paid and cash received in respect of purchase and sale of capital assets, but never their associated depreciation or losses or profits on disposal. In profit and loss financial cases include future expenses and revenue that differ among the alternatives, include depreciation and losses or profits on disposal of capital assets, but never their associated cash flows. Exclude sunk costs already incurred that cannot be recouped. Reasons to consider offloading the expense and capacity of IT to an outsourcing firm include if another firm may be better, faster, and cheaper at providing IT services, particularly if one's firm is not in the IT business. On the other hand, it is never advisable to outsource the firm's core business or to give up control of proprietary processes or other assets and talent that are unique or critical to the success of the firm. Since cloud computing allows a company to separate IT services from the need to invest in computing infrastructure, the company benefits from the typical advantages associated with outsourcing services. Among these advantages are greater responsiveness to their own customers and core business needs, increased efficiency, flexibility, and scalability, and reduced capital expenditures. The end.